Welcome to today's options, futures, and FX trade update. So today we're going to cover our existing trade on SPY. We're going to just discuss briefly a risk management plan just in case it comes under pressure. Because we're looking at opening up a second trade on SPY in the near future, and it's going to be a ratio put spread. So I want to spend a bit of time on that. Just on oil, not ready to trade oil yet. I want to just see, does it retest the lows? So oil's probably not going to happen today unless there's a big turnaround. And then finally, I'm going to discuss our spread betting platform. We're going to look at some of the rules if you are going to trade FX on that. So remember, for residents of the UK and Ireland, spread betting is tax-free. So we're going to show you the rules you should be engaging in to be trading some of the currencies and if there's anything setting up for today. So first things first, let's look at the charts on SPY here. You can see yesterday it was down 1.7%. And in pre-market, it looks like the sell-off might continue. It's down just 0.25%. Now, that could change. It's still early days yet. But that's great. And the reason is if you look at the VIX here, and for those of you who are new, the VIX is simply a volatility index, and it measures the volatility in options in the S&P 500. And when it's high, it's great for selling option premium. So that's the reason why we're setting up a second trade on SPY. But let's discuss our initial trade. So remember, and again, just to highlight why the trade we place is so good. If you look at it there, we sold the $620 put options on SPY, basically ensured the value of SPY, and it could fall all the way down to here and we still make a profit. So it can go up, it can go sideways, and it can fall, as long as it doesn't fall below 620. And the statistical probability, by the way, of that actually happening is less than 5%. And that's why it's such a brilliant trade. So if we go straight into our trade now that we have on, you can see here at the minute, we're still in profit in this trade, even though the market sold off 1.7% yesterday. We're still up $181. We were up a lot more yesterday before the market opened. We still have a potential profit of $317 to gain in this trade. And we've made about 36% of our total maximum profit. So we're going to stick with this trade. There's nothing to do, but it's always prudent to have a risk management plan in place just in case things go wrong. So let's discuss that now. And again, the beauty of this strategy. So again, just to remind you, we're not going to do anything with this trade. We're just putting a risk management plan in place just in case something happens. So that risk management plan would involve rolling out our short 620 put. So if we were to buy this back now, it would cost us $3.42. But look what happens now. If we go to the January expiry here, we could actually roll that down to the January expiry, which is further out, and down to the $585 strike. And you can see we would generate then a premium of $340, which would pretty much offset the cost of buying ourselves out of the 620 short put for December. So that's how you can manage this trade. If things start to get a little bit pressurized, which I don't envisage that they will, but you never know. You always have to have a plan in place. This is what we would do. So for that reason there, if SPY actually did fall to $585 in this scenario, I'd be more than happy to take assignment there. Now let's look at our next trade that we're lining up. So remember, when volatility kicks up, it's great to sell option premium. You're getting paid your most for doing it. So the next type of trade, it's slightly different to the short put. It's where we're trying to actually benefit on the way down. So if we think, for example, this is going to fall a bit further, we want to start making a bit of profit from that. And also, we're going to have a naked put underneath. So what we're looking at is doing a bear put spread and adding on another short put below it, which is turning it into a ratio put spread. So what I'm actually looking at doing is buying the $660 put option around here. So that's your 660. We're going to buy the 660 put. We're going to sell twice as many as the 550s, which is just down here. So what we're hoping to do is profit from this negative move, okay? And the second leg, though, at the 650, then we start to eat into that profit as it starts to go below 650. But ultimately in this trade, our break even is going to be in and around 630-ish. And we're going to look at the December contract on that. And we're going to generate a credit on this. And let me explain all the outs on it right now. So we're looking here at the SPY December 19th expiry, which is about 35 days away. And remember, we're trying to take advantage now of a bit of a shoot up in implied volatility. So we're looking at buying the 660 put. Okay, that's the first leg of the trade. And the second part of the trade now is we're looking at selling the 650 contract as well. So that's a bear put spread if we just left that alone. There would be a debit cost to that. Now we're going to turn that into a credit. In other words, we're going to get paid for that, but we're putting in additional risk here. Okay. So you can see if we left that trade alone now at the moment, we'd only have a probability of profit there of 31%. But look what happens now when we change the ratio here to 2. Look at our probability of profit. It jumps up to 88%. And our break even, as I said, is going to be at about 635. So ultimately what we have here is a bear put spread from the 660 down to 650. We want the share price of SPY to fall to 650. And then underneath that, we have another short put, which is basically a bullish strategy. So we don't want it to fall below 650. But if it does, we still make profit all the way down to 635.43. Again, the reason it's a high probability trade is, remember, SPY is trading at 670 at the moment. So SPY could fall another $35, which is what, the guts of 5%, 6%. And we will still be in a profit here between now and December the 19th. That's why it's a high probability trade. And we're getting paid this credit of 465. So that's the trade we're looking at here and now, okay? Now, again, a risk management plan in place for this. If, for example, this started to come under pressure and we felt different about it, we could actually, if SPY gets to 655, for example, we could decide to roll out one of those legs out and down into the January expiry. So having a quick look at that, you can see here our 650 leg is generating 738. So where will we get 738 in January? Let's have a look. And you can see there, that's at about the 630 strike. So worst case scenario, we could buy ourselves out of one of those 650 contracts at this minute in time even, and we could roll it out and down into January down to the 630 strike. But remember, our break even would still be plus 10, which brings it down to 620, and the initial credit we took in, which is around 450. So our break even will be in and around 615 in that trade. So here you have our next trade we're going to line up. We like the way the market is setting up and the volatility is creeping up. That's why we're getting paid to put these trades on. But we think this pullback is going to be temporary. And by the way, the pullback at the moment is due to a couple of Fed speakers yesterday, but didn't indicate that there was going to be a rate cut for December. And that's spooked the markets a little bit. And that's why bond yields have gone up too. Okay, so that's the trade we're lining up. So moving on now to our spread betting in a tax-free environment. So again, for residents of the UK and Ireland, you can spread bet here and it's tax-free. Now, we're not going to discuss the options one here. We're going to discuss here if people are interested in currency trading on a daily basis. So just a couple of rules, and I'm putting out a video later on, by the way, on the exact rules of this. It'll be about 4 to 5 minutes long. You can watch that. But bottom line is, try not to hold any of these trades overnight. Look at a 15-minute chart and use RSI as your indicator, but start with looking at the initial trend, first of all, on a daily chart. So, we're looking at the euro dollar here, for example. It's clearly going sideways at the moment. You can't see that there now because I've got all my writing in there. But if I take that writing out, you can see we're in a sideways trend here at this minute in time. So, and that gives me a bit of comfort when I'm trading this, that we're not in a kind of, if you're in a big bullish channel or a bearish channel, you wouldn't trade against that when you come down to the shorter time frame. So going down to the shorter time frame here, we're going to go to a 15-minute chart. What I'm looking at here, I know we're in a sideways channel, but I look at this short-term 15-minute window here, you can see we're in a bullish channel here. So if RSI gets below 30 here and crosses back above it, we want to buy. And then the rule is to close out when it gets to 50 and vice versa. If it gets above 70 on the RSI, you sell and then you buy yourself out of the trades when it gets to 50. So I'm using my trigger to get out of these trades at 50. And don't forget to set your stop losses. So the euro dollar is one there where our RSI is down here at the moment at 34. So it's not too far away from getting below 30. That could be a possible trade. Now, we've gone from high probability trading in our previous screens to this is 50-50 stuff, guys. You want to be kind of watching it and put your stop losses in place and watch the video I'll put out later on. Okay, that's it for today, folks. Please send me a WhatsApp or message me through the website if you have any questions. Thanks and bye for now.